Welcome back, everybody, to this third session today, which is on capital markets, ageing and pensions. And the overarching issue that we're going to address, hopefully today, is in the European context, the potentially explosive combination of four negative adverse trends. One, the demographic trend of rising dependency ratios. Two, the growing pension liabilities and increasing numbers of pension schemes in deficit. Three, falling returns in capital markets, especially in those assets such as gilts and other government bonds that pension funds invest in to match maturities between assets and liabilities. And four, the regulatory constraints following Solvency II and Basel III that inhibit pension funds and life insurance companies from diversifying into higher yielding equities and other long-term but less liquid investments. This diverse confluence of factors is not, of course, a solely European phenomenon. We only heard last week how pension liabilities in the United States have been hugely underestimated, with a collective deficit now estimated to be a staggering $3.4 trillion. However, the European problem is arguably even more serious because investment yields here are lower than in the US, dependency ratios are higher, and a much larger share of pension liabilities fall in the public sector. We have today two people who are hopefully going to come up with some solutions to this. Christian Tiemann, Group Head of Strategy, AXA, who formerly worked at the IMF. In fact, we were colleagues.
Yes.
Helped solve the Asian crisis, I believe.
We did.
Ashok Gupta, who's chair of the Defined Benefit Task Force, Pension and Lifetime Savings Association. And these two presentations will be then subject to intense box of scrutiny from two professors, Professor John Milbauer, fellow at Nuffield College, and Colin Mayer, professor at the Saïd Business School and fellow at Gilt. So I will not delay things any further, and I will ask Christian to take the podium.
Thank you very much, Adam, for this introduction and seeing you after, I think, 2 decades ago when we met at the IMF. I'm very happy to be at Oxford this afternoon and speak about the issues that Adam has just outlined. And I would like to thank Ian Golden very warmly for the invitation. And I'd like to commend the whole team at the Oxford Martin School for setting up this conference so skillfully. My topic today is essentially, to put it more easily, to care about the future. We all have seen the projections of aging in many advanced economies, the strain on public pension, and the need for long-term private saving. And the challenge we are facing is that all of this has to take place in a context in capital markets where interest rates are near zero. As you know, for example, the 10-year government bond rate in France is currently around 0.5%. The 10-year bond rate in Germany is 0.2, and in Switzerland it is minus 0.2. So the question is, how can we work in a world where there's no financial return for those who think about the future? Because if you put yourself in the early perspective, when interest rates were, let's say, 3% on the long end, if you put money away for 15 years, you increase the financial return by 50%. Now, after 15 years, you get the same as you put in nominal terms. The inflation rate may be lower, but we will come to this, that this is not so straightforward. So I'd like to focus on this, but inspired by the conference title, I'd also like to say a few words on the situation of Europe. So if you like, my introduction this afternoon could be with the subtitle, The Future of Europe and the Price of the Future. Europe is an exceptional project. It is the way to peace, stability and prosperity for a continent that has been torn by wars, economic frictions and national particularities. But the last years in particular have shown that the debate about Europe can actually hurt, can actually give rise to resentments and stereotypes and can be very difficult. And I believe we have to ask our question, how come that the debate about Europe is so difficult? I would like to offer the following. I would like to offer the thought that the debate about Europe is so difficult because of 3 things. 1, Europe is a project that is only positive. Since Europe is the path towards a bright future and away from the dark past, everybody is in favor, in general, at least, and maybe on the continent much more even, about Europe as a general concept. So it's very difficult to have a debate about something that is appreciated by everybody, and the return against would be something going back to the past. The second reason why the debate about Europe is difficult is because the European process is like a gear wheel, if you like, that can only turn forward but not backward. Whatever is done at a European level, whatever is created, is there to stay. It's very difficult to wind back certain things because, again, going back would be going back in time and going back in this process towards peace and stability and prosperity. So the notion of Europe being a wheel that one can only turn forward, not backward, is another facet that makes the discussion so difficult. And the third one, I would say, is the fact that Europe is additive, if you like. By this I mean, whatever the state of Europe, it means you can always add something. And Europe is made by adding things. And this has two implications. One is that Europe is by definition always seen as incomplete. Whatever the state of Europe is, you can say, we have to do more. And this has difficulties for those who would like to do more because they're frustrated by being always incomplete, and those who believe we should preserve the status quo because there can always be an argument being made about Europe going further. So it's never a notion that is static. It's always a notion that is dynamic. And something else has happened in the recent, I would say, 2 decades, which has changed the debate about Europe, is the following. Europe started as a project for growth. When you remember, Europe was very much designed as a single market, lowering transaction costs, greater efficiency, innovation project. It was a project meant to be designed for growth, to bring higher growth and higher innovation to the continent. And over the recent years, and certainly accentuated by the crisis necessarily, it has become much more about distribution. About distribution means sharing of resources, sharing of institutions, sharing of competencies, creating a network of stability. And these are, of course, very, very different concepts. Talking about growth means to talk about things like competitiveness, talk about things like innovation, talk about things like reforms, modernization of the economy. That's the growth agenda. Distribution is a very, very different concept. Talking about distribution means to talk about integration or inclusion, talking about avoiding exclusion and avoiding separation. So as you see, the debate is very different, and Europe has very much shifted from the focus on growth, where we told the people it's a project that will bring higher growth trajectory, to a project where we discuss very much distribution issues, and that has fundamentally changed the debate. But these questions are nothing compared to the new one. And the new one is, where is time? Accommodative monetary policy brings the future forward. Lower interest rates boost spending, boost investment, boost consumption, and therefore boost growth. And that's the picture that it looks like. But currently, so much that the future has no additional value anymore. If interest rates are zero, it means there's no value, no financial value, no return for bringing savings forward. So there's no financial reward anymore for thinking about the future, for patience, for savings. But human beings are very much future-oriented. We all care about the future. Every economic actor does. Individuals care about the family, the children, the parents, the grandparents, the grandchildren, and their future. And so do firms and innovators. So the question then becomes, can the present be dynamic without the future? And luckily, we are not the first to ask that question. There's somebody before us, many centuries before, and that was Saint Augustine, who, as you know, wrote the Confessions and devoted an entire chapter to the question of time. And ironically, it's chapter 11. So what does he say about the notion of time? He says the following: how can the past and the future be when the past no longer is and the future is not yet? As you see, the subject was difficult already at the time. And then he says, as for the present, if it were always present and never moved on to become the past, it would not be time, but would be eternity. So the question then for us is, are we now stuck in an eternal present? Or to put more concretely and come to our topic, how to think about aging and retirement gap with no reward for the future to invest in? That's the question we need to look at in more detail. So far, people saved for retirement, and we know that's the bulk of savings, with three motives in mind. First, return. Second, guarantees, a very important combination. And third, liquidity. Together establishing, if you like, the triangle of desires. These were the three kings of savings: return, guarantees, and liquidity. A very important picture and a very important combination. Because with these three factors together, people were achieving, through return, a long-term income, through the guarantees, a peace of mind, and through liquidity, flexibility. That was the state of long-term savings. But today, there are question marks over all three of them. There are question marks over return. There are question marks over guarantees and the ability to provide them. And there may even be question marks over liquidity. But you may ask, do people really need return? After all, inflation is zero, right? And the answer is no. Inflation is high, at least for those things that matter. And these are the things that are most important for long-term savings, like health or housing. And here you see, over the last 15 years, the nominal health expenditure in the OECD countries that has risen by 140% over the time. And most of the increase was due to nominal price increase. In many countries, the price for healthcare expenditure is about 4 to 6% a year. So health is an item which people save for, healthcare for themselves, for their parents, for their children, whatever, and the price is increasing very significantly. You also see house prices here, and you see over the last, in the middle, the red line, that over the last 4 years alone, house prices in the OECD have risen by as much as 20%. And we mustn't be deceived to look at averages in regions, because what is really interesting and relevant is the house price in urban areas, because that's where the jobs are. And here we see very, very significant house prices. So even though the average inflation rate may be zero, the price increases for these items for which you save for are very significant and much higher than zero. And when you're young and want to save, you don't save for the future consumption basket, not the average basket, because this future income will cover. You save mostly for a house. And when you're mid-aged and you feel a bit older, you save because you save for healthcare. And when you're mid-aged and want to care for your children, you give them some money. It's not in order for them to give the average consumption bill, not a toothbrush, some potatoes, and a few barrels of oil. What you want to help them is to provide, again, housing for them, or maybe education. But all these are items with a very significant price increases. And this is why we need to think about a positive return for long-term savings. Or put the other way around, if we don't have it, we create stress on people and the families and all the savers. Now, we may think of a solution, and this would be to invest not in government bonds or debt securities, but in equity or stocks. That's the first answer people come up with and say, yes, of course, you can't invest in government bonds, you have to invest in equities. But this is a solution that works more easily in some regions than others. It works quite well in the US. People are risk lovers and the markets are broad and deep. But it does not work so much in continental Europe. Why? Well, don't forget, when Mayflower left, many hundreds of years ago, Mayflower did not take an average sample. Mayflower, I don't know how and why, took the risk lovers. So the risk lovers, they left. They wanted adventure. They wanted They invested in equity. But the people who stayed behind, they want security. Our people stayed, and these are our people, that's us. Our people ask for guarantees. And if you're in continental Europe especially, and you ask the young people, they want guarantees, they want financial security. And this is also rational maybe because markets are much thinner in Europe and also significantly volatile. Here you see the French main government equity stock market index, CAC 40, and the saver who invested in November made 5% return in December. But in February made minus 20% without any change in the macro environment. So would have lost a fifth of savings. And even in a long-term perspective, the health holds true. The CAC 40 was 6,000 points in 2000. Now it's 4,500, 16 years later. So this is why we cannot just look at return, we must also look very closely at the question of guarantees. Our people want guarantees. So we have to go back to the triangle and search for a solution. If long-term savers need return and need guarantees, can one reduce liquidity? That might be the most likely path ahead. Because as we saw, achieving returns is possible, but difficult. One needs patience. One needs a long-term orientation. But the problem is, we have marking to market on a daily basis. One needs to look at productive assets, of course, because they are the returns, but our system is very much focused on sovereign bonds. One needs regulatory differentiation, but our system very much has uniformity in bonds. Think of the framework for systemically important insurers that is very much modeled on the one for banks, despite a very different business models. So the question is then, how can we move forward to revitalize the future and give momentum to the present? And here come 5 concrete options. None of them is easy, none of them is impossible, none of them is revolutionary, but each of them requires a significant change in courage. And all of them require not to look backward at short-term stabilization, but to look forward and reinstate the notion of time. The first option is to give value to time and to design alternatives to marking to market. For example, accounting based on confidence interval, ranges, period averages, or duration of investment. This is to avoid daily swings in valuations that are quite meaningless for long-term investors. And the Oxford Martin School has done a lot of work in this area, I think in particular the work by Doyne Farmer, for example. Option 2 is to rethink long-term products and savings. And Christian Gollier has written about this, and the governor of Banque de France, François Villeroy de Gallo, has given speeches about this. So this would mean to look at actual needs of savers and provide term guarantees. That means guarantees at the end of the period, rather than guarantees over the entire investment horizon. And this needs much less capital and would still provide security to financial savers. So this would be to provide a long-term orientation and rethink our long-term savings products and investments. Option 3 would be to allow asset allocation and capital charges to match liability duration. Specifically, and Adam alluded to this, one way could be to complement the one-year horizon that applies in Solvency II to the whole balance sheet with more granularity so as to allow for a better matching of the liability duration with the asset investment. Option 4 would mean to be consistent in regulating differently different financial actors. And Ian Golden has written a lot about the need for diversity in financial regulations and diversity in financial systems. And this would also mean perhaps not to regulate entities on size and legal status, but on activities. It would be an horizontal approach much more than an institution-based approach. And finally, option 5 would mean to put the issue of value creation for long-term savings high on the agenda and make sure that financial institutions reach their economic purpose and use innovation to this end. So this would mean really to see that we have specific offers and specific role for long-term savers and try to help them reach their aims of returns and some form of security. With such reorientation, one would at least achieve 2 of the 3 points in the triangle, namely return and some form of guarantees at least, and liquidity would be reduced because some way has to give. We cannot achieve all 3 items in the current market environment, and liquidity would be matching the long-term horizon. As I mentioned, this would be needing bold action and a lot of conceptual work, but would be no revolution either. The challenge of our time is to reinstate value and financial reward for those who plan for the future and those who think long-term. And by reinstating the future, the present would not be eternity, but would feel more dynamic too. Thank you very much.
I'll let you do the slides. Good afternoon, and thank you for allowing me to take part in today's very interesting debate. I'm going to cover a slightly different aspect to that of Christian. I'm going to focus on the pension liabilities that we've built up, and particularly the occupational pension liabilities. And it's important to understand the significance of Europe's occupational pension sector. It comprises 3.5 trillion euros in terms of assets. And if we look at that, how that's distributed across different countries, this is a selection of the funded pension. This is funded pension assets or liabilities. So it's actually the assets of the pension schemes as a percentage of GDP across a selection of countries. And as you can see, the funded pension liabilities are very unevenly distributed, but in the countries that have them, they're very significant. So if you take the Netherlands, Switzerland, UK, Denmark, Ireland, funded pension liabilities and assets are highly significant. What this slide doesn't show is the unfunded pension liabilities, which are predominantly public sector, but also include some private sector, particularly in those countries which don't have funded pension liabilities. Now, it's very difficult to quantify the unfunded pension liabilities because they're held off balance sheet. But Citigroup estimate that unfunded pension liabilities equal twice the national debt in most European countries. So again, these are very significant. But I'm not going to focus on the unfunded liabilities today, I'm going to focus on the funded pension schemes. Christian's already spoken about how saving for retirement influences people's spending. But pension funds play another vital role, and that is as providers of long-term capital. And that's a vital role that's often overlooked. There's been some work done by the World Economic Forum, and they've identified that pension funds and life companies provide 80% of the world's long-term investment. Now this slide shows total investment assets of 65 trillion. Of that, long-term assets investments, 27 trillion, with pension funds providing 40% of that, and life companies predominantly helping people save for retirement, providing another 40%. So this is a vital role that pension funds play. The second point I want to make is that Europe's pension industries are in crisis. Why? Well, first of all, we're all living longer. And we've heard from Ian earlier today about increasing life expectancy, increasing dependency rates. And I'm not going to repeat that, except to say that all of that makes the promises, historic pension promises that have been made, more valuable and more costly. And because we value liabilities by discounting future cash flows, when interest rates decline, the liabilities go up. And so the deficits are increasing. So if we look at pension deficits, here's illustrating the pension deficits of the UK FTSE 350 companies. And you can see that over the last 4 years, pension deficits have quadrupled. And these pension deficits are measured on a very optimistic basis. Realistically, they're 3 to 5 times that level, illustrated here. Now, when you ask what's been the industry's response to this crisis, it has been to de-risk their investment strategies. Here's a quote from an OECD report on pension fund long-term investment. Now, when you cut through this language, what does this actually mean? Well, this is taking UK pension schemes. This has been what they've been doing to their investments. This shows the asset allocation of the UK pension sector. And the dark blue bit shows the investment in equities. The light blue bit at the top shows the investment in property. So if you take those two components, that's the investment in real assets. And you can see over the last 15 years, pension funds had 80%, UK pension funds had 80% of their assets in real assets, and today it's about 40%. So there's been a 50% reduction in risk bearing by pension funds in the last 15 years. Now, our current approach to managing pension schemes is, in my view, damaging, misguided, and unnecessary. Now, that's a bit of a claim, so I'm going to explain it. When I say damaging, it's damaging to our economies. The economics of pension schemes are very simple. I've got another triangle here. And basically, what you have with pension schemes, you've got 3 levers. You've got the benefits, you've got your investment, and you've got contributions. And of course, you have expenses as well, but that's a very second-order lever. So these 3 are really the only 3 levers that are going to make a difference. And when your benefits are growing, which they are because we're all living longer, and if you de-risk the investment strategy, then there's only one. What happens is that you crystallize the promises that have been made. And there's only one thing that you can do in that case, and that's increase the contributions. And as a result, employers and governments are diverting capital away from industry and infrastructure and pumping them into pension schemes. And that's a massive drag on economic growth, particularly at the current time. And what's more, it's a massive intergenerational transfer of wealth. 2 baby boomers from their children and grandchildren, which to me seems a bit daft. It's also misguided. Now, let me explain that. Pension scheme liabilities are very long term. These are the pension scheme cash flows from the UK Pension Protection Fund. Now, that's a lifeboat for failed pension funds in the UK. And because these funds are all closed and failed some time ago, these are shorter than average. But as you can see, the cash flows only peak in about 25 years' time, and then take a further 40 years to run off. So we're dealing with a 65-year problem. And these cash flows are remarkably stable. There is very little that you can do to change these cash flows, apart from cutting benefits. That's what you're committed to do, to paying out. So the liquidity needs of pension funds are very low and very clearly defined. But our thinking as Christians pointed out, our regulation, our accounting, our industry practices are all based on efficient market theory. And efficient market theory uses volatility as a measure of risk. If you have cash flows like these, volatility is irrelevant, is largely irrelevant, except, yes, you've got some payments to make up in the next couple of years, but apart from that, volatility is the least of your worries. And 1 year VAR is a very bad measure of 20-year risk. The other problem with efficient market theory when you apply it to long-term liabilities is it assumes liquidity is free and valueless, which again, I think we've learned is not the case. But that assumption doesn't help pension funds exploit their inherent illiquidity. And so the end result is we've managed to take something incredibly stable, like these cash flows, and convert them into something highly volatile. And then we've taken that volatility and replaced it on the balance sheet of the corporate sponsors. And we've made their balance sheets highly volatile as a result. And that's encouraged them to invest short term, which is why they've de-risked. Ian Golding, Colin and John and I were all involved in a study done by the Bank of England into asset allocation by pension funds and life companies. Now, in addition to the de-risking that I've identified earlier, this study identified other things. In particular, that life companies, not just in the UK but in France, behave in a pro-cyclical way, and that there's massive herding in the pensions industry. And that herding has led to distortion in capital markets, particularly suppression of interest rates in the index-linked gilt market, and instability during the credit crunch. So that leads me to ask, is this necessary? And I'd like to answer that by considering the impact of low interest rates on pension schemes. Now, apart from the short-term liquidity needs, the real issue for pension funds is returns, not yields. And if you invest in cash and bonds, then clearly your returns are going to be lower. But then you ask, why would a pension fund with cash flows like this be investing in cash and bonds? Why shouldn't they, logically, if I'm saving for my retirement, shouldn't I be investing in building businesses and infrastructure whose profits are going to support my lifestyle in retirement? And that's true whether I'm an individual or a company. So the real need for cash and bonds is low, yet 50% of the assets held by large corporate pension schemes in OECD countries is in cash and bonds. Should we not be investing more heavily in risk-bearing assets and exploiting pension scheme liquidity to invest long-term in inefficient, illiquid markets where we can get better returns? Since pension scheme liabilities are real, we need to invest in real assets. And one organisation that's demonstrated the power of doing so is the Canadian State Pension Fund, CPPIB. And it invests 50% of its assets in alternatives, particularly illiquid assets, and has generated a 5.8% per annum real return over the last 10 years, or 8% nominal. Our current approach to managing pension schemes is this: increasing benefits, reducing investment, increasing contributions. We need to move to this. We can't do much about increasing benefits, but we can increase investment risk, and in doing so, hopefully reduce contributions. Our current approach, based on efficient market theory, is flawed. It leads to misallocation of capital on a large scale and puts benefits at risk, more risk than they need to be. And in many countries, our pension industries are fragmented, expensive, have low skills, heavily dependent on consultants, which in turn introduces agency risk. So we need a debate about pension scheme consolidation. There was an announcement in Ireland 2 weeks ago that the regulators having a consultation about consolidating their 150,000 pension schemes into 100. The task force set up by the trade body in the UK, the PLSA, which I chair, is looking not just at these problems, but considering consolidation of pension schemes in the UK. If you're managing pension schemes, you're more in the business of climatology, not meteorology. And mark-to-market is meteorology. And if you've got increasing longevity, you can afford to invest longer term because we're all living longer, we're retiring later, we're drawing down our pensions later. Managing them on a short-term basis is resulting in a massive drag in the economy and doing our children and grandchildren a great disservice. Given I'm probably the only actuary in this room, in a room full of economists, I'm probably the person least capable of calculating the cost to our economy of our current approach, the benefits to our economy of a more long-term approach. But this is a really serious issue, and the sooner we address it, the better. Thank you.
Thanks very much for inviting me to discuss Christian's really interesting paper. I actually was sent a copy of a more sort of discursive paper, which doesn't exactly match the presentation. Christian has gone beyond that paper in the presentation, but I'm going to talk more about the macroeconomics of this. So, as he said, the long-term savings vehicles...
Put it full screen.
Sorry?
Here's put on full screen.
Oh, sorry. As you said, long-term saving vehicles try to meet these three objectives: guarantees, security, reasonable returns, and liquidity. And in the paper, the more discursive paper, he discussed whether QE and low interest rates are not posing serious problems for the future in terms of social stability by threatening the guarantees by which standard life and savings insurance contracts are based, lowering returns. As he pointed out, it's inflation rates for health and other care and retirement and housing, which are above average inflation, and then the effect on real estate prices. And he is sceptical in his paper on whether there's a housing wealth effect. Now, I agree with all of that, and so does the German establishment. These are the reasons why Germany has been so hostile to ECB policy. It's a major part of the reason. And let me explain that a bit. Well, in his paper, there's this quote: "This paper does not call into question the monetary policy validity of QE," and I'd say that it should. So I think there's more to it in terms of the macroeconomics. So Christian's pointing to the social consequences of these low interest rates, real interest rates for the future. And I'd say that actually there are some immediate macro problems being caused by these policies. And they're closely linked to Ashot's paper as well. So the first point is that the effectiveness of QE is very institutional and context dependent. Now, early QE in the US was very effective. It helped to restore liquidity of financial institutions, supporting prices of risk assets, equities, homes, corporate bonds. And later on, QE, which was seen as credit easing, improved credit flows, especially to the US mortgage market. And in the US, that mechanism really worked. It was powerful. In the US, there's a powerful home equity channel of monetary policy transmission, which works via higher house prices, the availability of mortgage financing and refinance. So the ATM machine aspect of US housing. In this picture, this is based on some research with people at the Fed. The red line is the consumption to income ratio, and the purple line is the contribution of this combination of higher house prices and the higher access to home equity withdrawal. You can see that the collapse in the financial crisis of the consumption to income ratio, that very large fall in the red line, is matched by what happened in the housing market. The combination of credit contraction and falling house prices had a really serious effect. And so restoring all of that was really important for recovery. So in Germany, Japan, France and Canada, higher house prices work quite differently from the way they work in the US. In these countries, exactly as Christian was saying, higher house prices actually contract consumer spending. So home equity withdrawal is expensive or impossible. So that ATM aspect of housing wealth is missing. And prospective first-time buyers need to save more for the large cash deposits, need to get a mortgage. So the house prices are going up, but returns on your savings are very low. It's really, really difficult to come up with that deposit that you need to enter the housing market. And renters, of course, worry more about higher future housing rents because they tend to follow house prices and are more cautious. We've done research on a number of countries and established this negative relationship. It's particularly strong in Germany, France, and Japan. And the other thing, which really ties in with what Christian was saying, Germany is a country, and Japan even more so, where savers are a very large and very important part of the population. So the total liquid assets of savers greatly outweigh household debt. So when you lower real returns, that reduces aggregate household spending. And in Japan, that's particularly important. That's the key reason why Japan's policies fail. Now, there are other reasons why conventional QE is not working. As Ashok pointed out, defined benefit pensions are hugely in deficit with such low discount rates. So companies, as he said, need to put aside profits, which means less investment. The other point about this mechanism, this low yield mechanism, is supposed to expand higher demand now in exchange for low demand in the future. Partly through incentive substitution, partly through driving prices to above fundamental levels. Now, after 5 years or 6 years of this policy, the future eventually arrives. So if you try to get people to spend more now and less in the future, well, when the future comes, we're in trouble. High house prices are also socially divisive because it's the affluent or their children who can overcome the greater down payment constraints and the greater difficulty lower income people have in accumulating the savings to enter the housing market. Negative interest rates hurt back profits, back equity, reduce credit flows. That's why the ECB came up with its recent targeted LTR subsidies. And of course, in a global context, retaliation by other central banks means that the exchange rate mechanism by which it's supposed to work is much less effective. So I think in Europe we actually have a fundamental problem to do with institutions, with constitutions. So under the Lisbon Treaty's Article 127, which is price stability, together with the ECB's target of under close to 2% inflation, in my view, this now contradicts Article 123, which is no overt monetary finance of the fiscus. which actually goes back all the way to 1992, to the Maastricht Treaty. Now, in my view, price stability is the primary target of the ECB. So it seems to me that if price stability is contradicted by no overt monetary finance, then we need some exceptions. We need to make Article 123 state dependent to allow temporary suspension. For example, if the inflation rate is particularly low and sustained low, and then the ECB could operate a money finance policy which doesn't interfere with each government's fiscal plans. It could offer to each government to finance in the first year an amount, let's say, of 2% of GDP. And alternatively, there's QE for the people, in which the ECB directly sends checks or transfers to citizens. So in this way, we could get over the negative return or zero return problem. We could actually live with positive interest rates and a growing economy.
Well, John has just given one set of potential solutions to some of the problems that Christian and Ashok presented in terms of getting monetary policy right. I'm going to suggest another set of possible solutions which are concerned with getting regulation right. Because I think we've got regulation seriously wrong, and it's interfering a great deal with the way in which European economies should be operating. We've discussed a great deal over the last 8 or so years the regulation of banks, but equally important are the regulation of non-bank financial institutions, because those determine in a particularly acute way the types of investments that are going on in Europe. And in particular in relation to some of the institutions that Ashok was talking about, namely pension funds and life insurance companies, we base our regulation on the notions of things like the minimum funding requirement and then the statutory funding objective in the UK to get the regulation of our pension funds right, and in Europe more generally the Solvency II requirements imposed on insurance companies. Now what these basically do is to encourage both pension funds and life insurance companies to match their assets with their liabilities. And given that the liabilities of, for example, pension funds are presumed to be fairly well determined, it means therefore that pension funds are encouraged to invest in low risk assets, especially index-linked government securities. And that's what they've done in a huge quantity. Now, to begin with, it's far from clear that this is desirable from the point of view that those regulations are designed to protect, namely the beneficiaries of pension funds or life insurance companies. Take a simple example. Supposing that there's a pension fund that has an ongoing requirement to meet expenditures of 100 million euros. And supposing that there are two types of investments it could make. It could either invest in index-linked government securities that pay 0.1 of 1%, or they could invest in equities that could yield either 5% or 1% with equal probability. Well, at present what they're encouraged to do is to value those liabilities at the index-linked government securities, putting them at about 100 billion euros.
so that a fund that has got 15 million euros as assets will have a 15 million deficit. Furthermore, since it's earning a return of that of 15 million to meet an expenditure each year of 100 million, its deficit is accumulating at the rate of 50 million. If instead it had invested in the equities, it could have set aside 10 billion euros, knowing that it will get at least a return of 1% and generate the 100 million euros income. Indeed, its expected return would be 300 million euros, and so expected annual surplus would be 200 million euros. Now that characterization is not actually too far from what's going on consistently in the way in which financial institutions and pension funds are making their investment decisions. What's happening is we're setting up a mechanism of regulation based on balance sheets to meet what should be a requirement to deal with expenditures from income. So we should be projecting forward income. We shouldn't be trying to look at the difference between two huge numbers generated by projecting incomes and expenditures way into the future and discounting them at very uncertain returns and determining what should happen on the basis of those two very large and largely indeterminate numbers. But that is having a very substantial effect on what the institution is doing. For one thing, it's encouraging institutions to pull out of providing decent pensions for their pensioners. So, for example, defined benefit pension schemes are closing in corporations at a rate of knots and leaving pensioners to manage their own investment through defined contribution schemes. But furthermore, if one then looks at those pension funds that are doing that and closing their funds, that you find that they are shifting dramatically out of equities into government securities. So on the left-hand side, you see the asset composition of pension funds that are corporate pension funds that are closing their defined benefit schemes, and since they're moving into a decumulation phase, they are shifting from equities into government securities. Contrast those with the local authorities on the right-hand side that are not closing their defined benefit schemes. They retain equity holdings. But it's actually much worse than that, because the net effect of this shift from equities into government securities is also having a substantial effect on returns on government securities. So if one looks at what's happened in terms of the accumulation of assets by pension funds and life insurance companies, the green lines show the accumulation of index-linked funds by pension funds and life insurance companies in the UK. The blue line shows the ratio of those to the issuance of new index-linked bonds. And what you see is that after the introduction of regulation in the UK in 1997, pension funds' accumulation of index-linked securities increased substantially in relation to new issues. The effect on life insurance companies is even longer lasting. It goes beyond 2005 until about 2010, because there was additional regulation introduced in relation to life insurance companies in 2004. And what the study that Ashok referred to in the Bank of England found was that the impact of that on government security interest rates is very dramatic, pushing down, for example, on 2-year bonds as a result of pension funds investments by about 70 basis points, or about 160 basis points on 20-year investments, and life insurance companies having an effect of between 30 basis points and 74 basis points on the 2-year and 20-year bonds. And those changes correspond very well to the changes in regulation and the changes in the pension fund and life insurance company investments to which I was just referring. But the fact is actually much more serious than that still. Because what is also going on is that it is fundamentally changing the nature of the ownership of the corporate sector. 20 years ago, before the 1997 reforms of regulation of pension funds and life insurance companies held 50% of UK equity. Today, after those regulatory reforms, they hold 8%. In a 20-year period, it's gone down from 50% to 8%. And in their place have moved these other institutions who are basically hedge funds and private equity companies. And the other additional buyers have been overseas investors. So we now have a combination of passive long-term investors and actively engaged short-term investors. We've completely lost the notion of there being long-term domestic investors in UK equity. And that is having a dramatic effect on the governance of UK institutions. It means that they're becoming increasingly short-term in their focus, and in large part, investors are becoming increasingly passive. Now, even if we could encourage pension funds and life insurance companies to become more active, it would be largely useless now because they are no longer significant long-term investors in our companies. What is happening is that we are focusing regulation on this savers end without thinking about what it is doing to the investment end of the market, the corporate end of the market. And not only is the regulation probably very badly designed for our savers, it is certainly devastating for our corporate investors. And this is not just a UK phenomenon. One observes exactly the same thing going on elsewhere in Europe, not to the same dramatic extent, because the UK has adopted these regulations with particular alacrity. And so it's had a particularly strong effect in the UK. And it goes for life insurance investments as well, where if you compare what's going on in Europe, it is much more significant than that in the US. So the basic message I want to leave you with is that not only does regulation matter, but bad regulation can have seriously unintended consequences and very unfortunate consequences for the European economy.